Good morning, dear learners. Welcome back. We are on to Module 1, Lecture 2, Objectives of Financial Management. In Lecture 1, we discuss about the concept of business finance, the traditional view of finance and the modern view of finance. In Lecture 2, we are going to cover scope of finance function, objectives of financial management, the concept of profit maximization and wealth maximization. These are very important concepts as far as the financial management is concerned. So, let us start. Scope of finance function. Finance function, what it is? It is a central nervous system for its money matters. As we discussed in the previous lecture also, if you remember, we compared finance with the nervous system. Nervous system in a human body is essential for proper functioning of a human body. Without a nervous system, the human body cannot function, right? Similarly, finance is considered as the nervous system in any organization. Without finance, no organization can function in a smooth way or a proper way. It is required for each and every activity, right from the startup phase to the growth phase, to modernization, to expansion, even during facing difficulties, as well as also during liquidation. Finance is important. A company or an organization cannot think of sustaining, cannot think of surviving or operating effectively without proper level of finance, and that is why it is known as, considered as the nervous system as far as the money matters are concerned. It is from planning and raising capital to managing expenses and making investment. So, when we are talking about finance, it is related to different activities. We are trying to raise the funds on the basis of the requirements, that is the raising of funds. We are trying to make investments in profitable revenues. We are trying to manage the expenses. So, all these activities are related to finance function. Scope of finance function includes estimating financial requirements. Under this, we have proper financial plan. So, first of all, an organization should try to estimate the requirements of the organization, the financial requirements of the organization. It should have a proper financial plan, and financial plan should be in such a way that it should ensure that neither you are having excess of funds, neither you are having inadequate amount of funds, because if you are having more funds than the required funds, you will not be having the profitable revenues where you can invest that money, right? And if you are having less funds than the requirement, you will find it difficult to meet your day-to-day requirements, pay creditors, purchase raw materials, pay wages to the workers. So, both are having their limitations. So, financial planning should be done in such a way that the proper requirement of funding is calculated, estimated, and that amount of funding is raised using different financing sources. Next is deciding capital structure. So, when we talk about capital structure of an organization, we are basically talking about the proportion of different long-term securities in the capitalization of an organization. So, what are those long-term securities? Capital structure basically includes the proportion of debt, equity and preference shares. Let us say a firm has the requirement of 100 lakhs, it raises, you can say, let us try to understand this, 100 lakhs is required, and out of these 100 lakhs, 40 lakhs is raised using debt, that is debentures. 40 lakhs is raised using equity shares, and the remaining 20 lakhs is raised using preference shares, right. So, this proportion 4:4:2 is the capital structure of an organization, right. Then selecting a source of finance. So, whenever the company thinks of raising money from somewhere, it has to consider various aspects. So, what are those aspects? Time frame, for how long that money would be required. Let's say you are talking about the long-term investments of funds, right? Let's say capital budgeting decisions. So in that case, we will be looking for long-term sources of funds, like in the form of debentures, bonds, equity shares. Cost. A firm should try to minimize the cost, because if you minimize the cost, the profits will go high, right? So in that case, if the firm tries to minimize the cost, it will be looking for those sources of funds which minimize the overall cost. In that case, the firm would be looking to raise more funds using debentures, because they are a cheaper source of funding. Control. The firm should also ensure that they do not lose much of control, and if you issue a lot of equity, then the firm will lose control. So in that case, the firm should be looking to raise capital using debentures or preference shares, but should be trying to avoid the equity shares, which dilutes the control of the existing shareholders. And the risk involved, and this is a very important criteria, because if you increase the proportion of debt in the capital structure, so the financial risk will increase, because the payment of interest is a legal obligation, and in linears, when you have less amount of profit or returns, in that case the company will find it harder to make payments. So company should avoid or minimize the usage of debt as far as the risk is concerned. So these are the parameters that drive the selection of a source of a finance, suitable source of finance. Next is selecting patterns of investment, use of funds. Okay, so once you have raised the funds, the next is putting the money into profitable avenues, where you want to invest the money, right? That is regarding, if you talk about long-term investments, you are talking about the capital budgeting decisions. If you are talking about the short-term, or that is about the managing money for day-to-day activities, you are talking about the working capital management. So first it should invest on fixed assets, and then it should be talking about the working capital management, which is management of inventory, management of cash, and management of receivables. Then continuing with the scope of finance function, working capital management. We already discussed what working capital management is. It is about managing the three things, that is cash, it is managing the inventory, and it is managing the receivables. Implementing financial controls. So any activity you are performing, if you do not control it in a proper way, you will not be able to achieve the target in a proper way. So when we have certain financial controls to ensure that the firm is going on the right track, right? So what are those financial controls? Return on investment. It is known as the ROI. Whatever amount you have invested, what is the return that you are generating on that? Let's say you invested 100 lakhs, right? So, and you fetched a return of 30 lakhs on this. So return on investment in this case would be 30%, that is 30% of 100 lakhs is 30 lakhs. So that is one of the criteria to judge whether the expected returns which the firm was hoping, are you achieving it or not? Budgets. Now it is a very popular technique to manage the expenses. It ensures that the expenses do not exceed the revenues. If expenses exceed the revenues, in that case the firm will find it harder to manage the money. Break-even analysis. So break-even analysis is also known as the cost volume profit analysis, or with the break-even analysis we can find out the break-even point. So what is break-even point? It is the point at which the total cost line and sales revenue line, they intersect. It's a kind of no profit no loss. So as soon as the firm reaches its break-even, it can plan for profit. So every firm tries to attain the break-even point as soon as possible, and it tries to establish relationship between cost, volume, and profit. So in a way it helps in profit planning. Ratio analysis. Now this is a very detailed topic. A firm can use various kinds of ratios, like we can segregate ratios in 4 major categories, that is the liquidity ratios, profitability ratios, turnover ratios, and leverage ratios. There are multiple ratios under these heads. So company can calculate various ratios to know how well a company is doing, and whether any other improvements are required or not. Let's say if we are talking about the liquidity ratios, that talks about the liquidity position of the company, and if these ratios are not as per the standards, the company needs to improve its liquidity position. Or if profitability ratios, let's say gross profit ratio or net profit ratio, they are not up to the mark, the company needs to ensure that they minimize the cost so that they can increase the profit. Or we talk about the efficiency ratio, the turnover ratios, they talk about how efficiently the assets are being utilized or converted into sales. Or we are talking about the leverage ratios, it talk about the long term paying capability of an organization. So these ratios indicate about the financial health and can be used to predict whether the company is going on a right track or whether some improvements are required or not, right. Internal audit, apart from these controls, the company can also go for the internal audit as well, which can help in identifying any flaws, any improvements required within the organization, right. Next is proper use of surplus, that is popularly known as the plowing back of profits. So whenever there is any requirement of fund and the company has two options, the external sources available to the company in the form of debentures, bonds, preference shares, equity shares, or the profits retained year after year, not fully paid to the shareholders, a part of that is reinvested in the company, and that is known as the plowing back of profit, retaining of the profit. And it's the best option for a company because it does not needs to depend on the outsiders for any expansion, for any diversification, or for any other requirements. So that is the proper use of surplus. Whatever you have retained, you can use it in some profitable revenues to generate higher returns. Next is managing risk. So anyway, any company which is working, so it has to face different kinds of risk. So first you need to identify the risk. You have to mitigate the risk, but before mitigating you have to identify the risk. So what are the different kinds of risk? It can be related to the market movements, there can be change in interest rates, there can be change in currency rates, and there can be, if you use more of debt, there can be financial risk. From a bank's point of view, if you are talking about, there can be the borrower does not pay the money, that's a default, so that's a credit risk. So you should identify the risk and you can take several steps to mitigate the risk. Let's say if a company is making investments in different shares, so you can increase the number of securities in the portfolio, you can diversify, right. That is one of the things. Apart from that, the company can use various hedging strategies to mitigate the risk, or they can also use the insurance to save their inventory from any unexpected events, right. Then reporting and compliance, financial reporting and compliance. Company which is listed on the stock market has to file the reports with the Securities and Exchange Board of India, that is SEBI. It should also publish their reports annually. The company should also ensure that the procedures they are following is as per the rules and regulations stated, right. Then examples, let's talk about few examples to justify the scope of finance function. A finance team at a movie studio. So a finance team at a movie studio will try to find out the let's say the cost associated with a film project and the expenses that it has to bear related to the promotions and the expected box office collections. On the basis of this, they will decide that whether we should put this much of money into a movie project or not. Similarly, a finance manager at a hospital, right. So these days a lot of companies are coming with health insurance and people are purchasing those health insurance and they are going to the hospitals and they do not have to pay to the hospital at that moment of time because it is being transferred to the health insurance companies. The finance manager at a hospital will try to negotiate with the health insurance companies and will try to get all the money reimbursed patients. So this is the work of a finance manager in a hospital. Relationship of finance function with other business functions, right. Now finance function does not works in isolation. It is one of the functions that is deeply linked to the other functions of an organization. There are multiple functions or departments in organization. Let's say what are those functions? We have the marketing department, we have the sales department, human resource department, operations or productions, and the R&D department. So finance function is deeply linked with all these functions, and these functions are dependent on finance function to get the funding for their respective usages. Let's start with the first one, that is the marketing. So finance function provides the budget to the marketing team, because marketing department requires funding for advertisement, for any event launching the product. So all these things require funding, and this funding comes from the finance department. Finance helps with pricing strategies. Now setting prices for the products is also a responsibility of the finance department, and they fix this price based on the demand of the product, what the competitor is let's say offering the price, and the different market complexities. On the basis of this, they can frame the price. They can also look into the cost of production as well. Next is sales department. How finance function facilitates and works with the sales department. Finance tracks revenues and profitability. So when a company does sales, it generates revenues. So finance department tracks the revenues generated through sales, and obviously the profitability that the company is making through sales. It also manages credit and collections. It decides the credit period. Let's say when you sell something, you have two options: you can sell it on credit, you can sell it on cash. When you're not getting the immediate payment, that is selling something on credit, right? So the finance department will set the credit period. Let's say you allow 1 month or 2 months time to the customers to make payment. That is the credit period. And similarly, the collections, if something is due, how the finance department will collect it, right? Next is human resource. Finance manages payrolls and benefits. It is the responsibility of the finance manager to ensure that the employees are paid regularly. The salaries are credited to the account of employees on a regular basis. That's the responsibility of the finance department. Finance budgets for HR activities. Now, only payment of salaries is not the function of HR. It is much beyond payment of salaries. It can be related to the recruitment, it can be related to the other training programs. These all come under the purview of HR. So this all things are sponsored, are taken care by the finance departments. Next is operations or the productions. Finance provides funding for is required to purchase raw materials, to pay workers. So finance function ensures that the operations is on track. Finance analyzes cost and efficiency. It also manages, look at the efficiency with which the operations department is working, and if anything is there which can help in improving the efficiency, they can point it out. Research and development. Finance funds R&D projects. Now research is very important for any organization. If an organization is not spending on research, then it is difficult to think of sustainability or long-term survival. So finance funds R&D projects, and this becomes very true in technology intensive companies or the pharmaceutical companies which thrive on good kind of research. Finance evaluates the potential return on R&D investments, right? So it will evaluate the potential of any product to generate return. Based on that, they will provide funding to the R&D department. Objectives of financial management. It is concerned with procurement and use of funds. We have already discussed this in the previous lectures also, that financial management is all about getting the funds procured and using it in an optimum way so that you can generate more return. Main objective: to use business funds in a way that the firm's earnings or the value are maximized. So the decisions that you take today, the investment decisions that you take today, where to invest, which projects to select, right, which markets to enter, whether to invest in R&D or not, all these decisions decide the growth prospects of the company. So it helps in maximizing the firm's earnings and value over a longer period of time. It is the compass and map for an organization's financial journey. Like when you go on a voyage, you need a compass and a map to reach your destination. Without a compass and map, you will find it difficult to reach your destination. Similarly, financial management can be considered as a compass and map for the firm's financial journey, right? Guides the company in making sound financial decisions to achieve its goals. When you talk about sound financial decisions, we are talking about the financing decisions, investment decisions, and dividend decisions, right? The various risk and return associated with all these decisions. So, company try to make sound financial decisions to achieve its goals, and financial management facilitates this. Core objectives of financial management. Now, this is a very important topic. There are two core objectives of financial management. The first one is profit maximization, and the next one is wealth maximization. Profit maximization and wealth maximization. So, let's look at them one by one. Profit maximization. So, what is profit maximization? Profit making is the core objective of any business. No business can survive without making profit, and business being an economic institution, it aims to make profit. It measures the efficiency. Basically, it's a measure of efficiency of a business enterprise, and if a firm accumulates the profit over a long period of time, it can be used to face difficult situations. There can be depression in the market, there can be adverse government policies. So, in that time, these accumulated profits will work and face difficult situations. So, making profit is absolutely important for any organization. No business can survive without earning profit. As we have already discussed, the business are economic institutions, and all economic institutions try to make as much profit as possible. And that is why profit maximization has been considered as one of the objectives of financial management. So, profit maximization is about finding the sweet spot where a company generates highest possible profit. So, it's that spot where the company can generate more and more of returns and more of profit. It's that sweet spot, right? And how can a company generate more profit? There has to be a delicate balance between two things. So, what are those two things? The first one is increasing revenue. How can a company increase revenue? If you sell your product more and more. So, first one is selling more products, finding new customers, and raising prices carefully. If you sell your products more, if the sales increase, then definitely the profits will also increase. If you find new customers, how can you find new customers? You enter new markets, underexplored markets. So, you will get new customers, they will purchase your products, your sales increase, and the profits will also go up if you also keep the cost at the same level. And raising prices carefully. And this is an important point. If you raise the price, there are chances that customers might switch to a different product. So, you have to raise the price, take into consideration the price offer which are available at a lower price, right? The other thing that the company needs to focus on is decreasing cost. You can increase the profit by increasing the revenues, increase the profit by decreasing the cost as well. So, you can streamline the operations, negotiate better deals with the suppliers, and reduce wastages, right? You can streamline operations means you can see if there is any duplicacy of steps, you can remove it. You can negotiate with your suppliers that you are purchasing on bulk quantity. So, in that case, you will be getting some discount in as far as the supplies are concerned, and you can also reduce wastages. Strategies to maximize profits. So, what the company can do to maximize its profits? That is, first is cost plus pricing. So, what is cost plus pricing? You just add a markup to the production cost. Let us say there is a bakery and the cost of production of a cake is, let us say, rupees 100. You add a markup of 10%. So, they will be selling it at 110. So, this is cost plus pricing, very simple. Value based pricing. Now, you charge on the basis of the value perceived. So, every product cannot come under this category. Let us say we take an example of luxury car brands. You talk about the Audi, Range Rover, BMW, Mercedes. These are luxury car brands and they can charge premium for the products. If you talk about the mobile phones also, the Apple or the higher variant of Samsung also comes under this category. Competitive pricing, you take into consideration what your competitor is offering and you try to align your prices to that level, right? Production efficiency. You can go for lean manufacturing. You can minimize the size of your inventory. This is what lean manufacturing is. Automation. You can use automated machines in place of workers, so that initially it will be higher, but in the long run you can save the money you are paying to workers. That can also help in maximizing the profits. Marketing and sales. So targeted advertising. What is targeted advertising? Let's say you're targeting a particular age group. Let's say a new PlayStation game has come into the market. The company can use social media to target a age group of 18 to 25. It does not need to get into the newspaper ads and spend a lot. So targeted advertising will keep the cost under check. Sales promotion, companies reducing the cost, coming with certain offers. You see a lot of sales like big billion sales, Independence Day sales, Republic Day sales. These all can be promoted. That is marketing and sales. Cost control, negotiating with suppliers. We have already discussed this. You can purchase in bulk and can get the raw materials at a lower cost. Reducing overhead costs, that is minimizing the expenses. Like you can move to a smaller godown and you can minimize the rent, and you can minimize the expense related to insurance, and you can streamline the processes to minimize the overheads. Let's talk about few of the examples of profit maximization. Airlines and dynamic pricing. Most of the airlines you must have seen increase or decrease or adjust their pricing according to the demand, right? And the timing that you book. Retailers and inventory management. The retailers like Walmart, and they try to optimize their inventory levels. They keep a track of the sales using the inventory management systems. Fast food chains and value meals. You must have gone to McD. They offer combo meals and value meals. If you're trying to purchase something in combo, you get discounts, right? That is the fast food chains and value meals. Tech companies and freemium models. Most of you must be playing mobile games, so you get the basic features of a game at free, and when you want for additional features you have to pay. That is the freemium models. Supermarket and loss leaders. Let's say you go to a supermarket, some of the products are considered as loss leaders, like milk, bread, eggs and bananas. These are products that are sold at a very low price to attract customers or to increase the footfalls, right? And once you go into the supermarket, you're bound to purchase few other things as well. Hotels and revenue management. Hotels increase their prices during the peak seasons or the festivals, or on the basis of demand or occupancy. Limitations of profit maximization. It's a short-term focus. A company might cut corners on research, employee training and customer service. It ignores risk. Company might be investing in highly speculative ventures, and it can engage in aggressive financial strategies such as taking a lot of debt. Neglecting stakeholders. It might neglect other stakeholders and emphasize on only a single kind of stakeholder. Ethical concerns might be there, such as misleading advertisements might be there. A company might exploit workers by increasing the number of working hours, harming the environment like it might be disposing the chemicals without taking proper care of and harming the environment. Difficulty in measurement. How can you measure the revenues and cost in the future? So it's revenues in the future. Changing business and has been changes in consumer preferences also. So taking these things into consideration, if a company focuses on a single product and is not willing to change, in that case you will see the company will find it difficult to adapt. The assumption of rationality. This concept, profit maximization, assumes that the people are rational, but they also take decisions. Their decisions are actually influenced by emotions and biases also. So always the decisions are not rational. Ignores time value of money, right? Now let's talk about the other objective, that is the wealth maximization. So it focuses on increasing the overall value of a company for its shareholders. Now, whatever decisions that you take, how they are going to enhance the value of the company. It's not just talking about the making profits right now, right? You are building a long-term value that will benefit shareholders, So unlike the profit maximization, which talks about maximizing profits right now, wealth maximization is a much broader concept and talks about long-term perspective. So under wealth maximization, the stockholders' current wealth in a firm is actually the product of number of shares owned, which here it is being reflected by N, and the current stock price per share, which is reflected by PU. So wealth maximization is N into PU. Now what is the benefit? It benefits shareholders through what? Increased stock price. If you see this formula, if you increase the stock price, that is if PO is increased, the wealth will be increased. If the company pays dividends, obviously the wealth of shareholders is going to increase. And if the value of the firm is increasing, it's a long-term growth, right? Wealth maximization, key principles of wealth maximization. It takes into consideration time value of money, whereas the concept of profit maximization does not takes into consideration the time of value of money. So what is time value of money? Money received today will be much will be having a much higher value than whatever you money receive after 2 months or after 2 years, right? Because money has the power to earn return if you invest it somewhere. Risk and return, whereas the profit maximization does not take into consideration the risk associated with the earning streams. This wealth maximization concept takes that into consideration. What are the benefits of wealth maximization? Increased shareholder value, long-term growth, and positive impact on stakeholders. Let's talk about few of the examples of wealth maximization. Companies investing in R&D, like we emphasized this point earlier also. R&D companies like Pfizer, we can talk about Sun Pharmaceuticals, Cipla, and we talk about technology companies like Google, or we can talk about Apple. They invest a lot on R&D because they believe they are investing in the future, right? If they invest more today, their profits might decline in that particular quarter, but they will earn much more in the coming years. Building strong brands, if you talk about companies like Coca-Cola, Nike, Nestle, they try to invest in brand building. They will be sponsoring some events, they will be advertising a lot, and they will be trying to build a brand. And if a brand is built, the customer loyalty is also built. Sustainable business practices. The companies are of going towards sustainable business practices where they are trying to decrease their footprints on the environment. Let's say we are talking, seeing a lot of car companies going towards the electric vehicles, right? This is a sustainable business practice that we have seen these days. Employee development and well-being. Companies know that they, if they invest on employees training and development, they will help in increasing the profitability over the long run. What are the limitations of wealth maximization? Difficulty in measurement. Because let's say, how can you say the decisions that you have taken today will have an impact on the price of shares in the long run? Because there are a number of factors which have an impact on the price of shares, right? Let's say we talk about various external factors, the sentiment of the market, any unexpected event like COVID, right? These days, if you see the policies related to tariffs taken by the Donald Trump in USA is having an impact on the stock market, right? The FIs are taking the money from the Indian markets, it is having an impact on the stock market. So whatever decisions you take, how can you be very sure that it is going to increase the value of the stock, right? Then comparing the difference between profit maximization and wealth maximization through examples. Now let's try to have some examples and try to compare these two concepts. Let's talk about the first one, that is research and development. So when you talk about the from the perspective of profit maximization, a company would try to cut R&D spending to boost profit, because they have a perception, they have a belief that R&D is expensive and does not generate immediate returns. So because their objective is to generate profit or generate return in each quarter, they try to maximize returns in each quarter. So they will not be much more inclined towards R&D. Whereas when you talk about the wealth maximization, a company which follows this, they will be saying that R&D investments are something that are making investment in the future. So they are actually opposite to each other. When you talk about employee relations, in this example, if you talk about the concept of profit maximization, an organization would cut employee wages, or you can say they would not give them good increment in the wages. to reduce their cost or minimize their cost. So what will happen? This might have an adverse impact on the morale of an employee. He will not be giving his 100%, right? On the other hand, if you talk about the wealth maximization, they will invest in employee development and create a positive work environment. Obviously, if you invest in training and development, there will be a cost, but a motivated employee will give his 100%, and in the long run that will add to the company. Environmental impact. A company emphasizing on profit maximization chooses the cheapest product method even if it harms the environment. As we have discussed in the previous slides also, they might dispose the chemicals directly into the rivers and it might pollute the environment. So it will erode the image of the company. Whereas the company emphasizing on wealth maximization, it will consider the long-term impact of actions on the environment and the community and adopt a sustainable practice. So they will be emphasizing that they should not harm the environment, and this will be building their brands also. And finally, the marketing strategy. Profit maximization, it emphasizes short-term sales promotion and discounts to boost immediate sales, even if it erodes brand image. If a company is giving too much of discounts and promotions every now and then, somehow it will create an impression that the company is not a very highly valued brand. So, but they will try to do this in order to increase their profit for a particular quarter, right? Whereas wealth maximization, the companies will try to build strong brand reputation. And how will they do that? Through consistent messaging, high quality products and excellent customer service. So these things come at a cost. If a company is messaging, if a company is producing high quality products, if a company is providing excellent service, all these things comes as a cost. But if company strives to do this consistently, then they can convert customers into loyal customers, and loyal customers will help in generating profits in the long run. So you can have these further readings. Thank you so much.